You sell a stock for a profit, feel good about the win, and file your taxes months later only to find out the government taxed that win at nearly double the rate you expected. There's a very specific reason, and almost no one explains it before it happens. The IRS treats investment profits completely differently depending on one single number: how many days you held the investment before selling it. By the end of this video, you'll understand exactly where that line is drawn, the rule that can accidentally erase a tax deduction you were counting on, and how professional investors structure their trades around both. Here's the line. Hold an investment for 365 days or less before selling, and the profit is a short-term capital gain taxed at your regular income tax rate, the same rate as your paycheck. That can be as high as 37%. Hold it for more than a year, and the profit becomes a long-term capital gain taxed at a much lower rate, 0, 15, or 20% for most investors. Same stock. Same profit. Dramatically different tax bill, based entirely on one date. This is why professional investors obsessively track purchase dates. Selling one day too early, 364 days instead of 366, can turn a lower long-term tax rate into the much higher short-term rate on the exact same trade. Now here's the trap almost nobody knows about, and it costs investors real money every single year: the wash sale rule. When an investment drops in value, a common strategy is to sell it, lock in the loss to offset other gains on your taxes, and then buy it back to stay in the market. That's called tax loss harvesting, and it's completely legal, with one critical restriction. If you buy the same investment or something the IRS considers substantially identical within 30 days before or after the sale, the loss is disallowed. The IRS calls this a wash sale, and it erases the tax deduction you were counting on entirely. This catches people constantly, especially with automated investing apps that reinvest dividends automatically. If a dividend reinvestment quietly rebuys a few shares of the same stock you just sold for a loss, that small automatic purchase can trigger the wash sale rule without you ever noticing. Your broker tracks this and reports it on a form called the 1099-B, but the responsibility to report it correctly on your tax return is still yours, and many people copy the wrong number without realizing a wash sale adjustment applies. The fix is simple: if you're selling for a tax loss, wait at least 31 days before buying back the same investment, or buy something similar but not substantially identical, like a different fund tracking the same sector, to stay invested without triggering the rule. And before selling any winning investment, check the purchase date first. If you're within a few weeks of the 1-year mark, waiting that short amount of time can move an entire trade from the high tax bracket to the low one. 3 things to check before your next trade. Know the exact purchase date of anything you're about to sell. 365 days is the line between two very different tax rates. If you're harvesting a loss, wait at least 31 days before buying it back. And watch out for automatic dividend reinvestment quietly triggering a wash sale you never intended. The tax code doesn't care how confident you felt about the trade. It only cares about the dates. Now you know the ones that actually matter. We track the financial traps that don't make headlines so you're never caught off guard. If this helped, subscribe. We post every day. I'll see you in the next one.